Hi, this is Rich. I'm going to explain to you the spreadsheet that you probably received from us, just so you understand how it works. The spreadsheet, it might be called conventional loan options or payment savings, etc. So what you'll see is, make sure it's your spreadsheet, you'll see your name and your address. You'll see a purchase price or value depending if you're doing a purchase or a refinance. And you'll see the loan amount here. Okay, this is an estimate. We usually wait for the payoff to come in to know how much you owe, or look at the credit report. Okay, you're going to see the lock period. By default, we use a 30-day lock period, but if your loan has actually been approved by the underwriter, we can go with the 15-day lock. The 15-day lock actually has cheaper pricing, so that means that you'll be able to get a little bit better rate than the 30-day lock. The problem with the 15-day lock is that you have to close it within 15 days, otherwise you have to pay for an extension. In a case where interest rates are going up, you might want to think about locking it ahead of time, meaning that you want to think about whether or not you should lock it in for 30 days instead of waiting for the loan to be approved. Okay. Several different columns here. You have interest rate, proposed monthly P&I, which is principal and interest, which is monthly payment, lender credit as a percentage amount, and lender credit as a dollar amount, closing costs, and net closing costs. So I'm going to explain to you how this works. There's usually 3 different rates that we put on here, and it's basically up to you to decide how much you want it to be. 4.375 has a payment of $19.21. It offers a credit of 1.375%. This is percentage of the loan amount here, which is how we got this number here. So essentially, 1.375 is a cost because it's not in parentheses. That means there's a cost to get this rate, which is 1.375% of the loan amount. $5,291 is the total cost when I take the loan amount times this number. The closing cost is actually a dollar amount. This is based on the purchase price, so we use the purchase price here. We just guessed 1%. We then take these two numbers and add together, and this is the total closing cost. You can see here that's $10,000. In this scenario, you can see that the payment is a bit more expensive. It's $19.49, which is about $30 more, but the cost is a lot less. So instead of being 1.375, it's 0.5%. So 0.5% of this is about $19.24, and adding it to the closing costs is about $67.34. So in a nutshell, this is a little bit cheaper, and it's $30 more a month. This option right here, 4.625, actually represents a credit. So you'll see here that the payment is $19.78. So comparatively speaking, you can see here that it's going up by $28, or from here it's about 50 bucks. Okay, a little bit over. And this receive a credit of 0.375, which is about $14.43. So in a nutshell, what that means is that the client that chooses this is going to have a credit. This credit will reduce the amount of the closing costs. It's still going to have a cost, but it's going to be $3,367. Okay, so we can actually go forward. So the higher the rate, the more credit you're going to receive. So although there's no such thing as a free loan, you can receive a credit to cover the closing costs. On a refinance, the closing cost is about $2,800, so you just need that much credit to make it a free loan. So when people advertise as a free loan, what they're doing is the rate is higher to where the lender is actually paying for the cost of the loan. You can also go this way. So I have some clients, if you believe that the rates are going to go up and never come back down, they're going to want to choose this, because although they pay a higher cost here, they never have to refinance again because they bought it down a little bit. So over the 30-year period versus this one, you're saving about $57. Okay, you can calculate the cost of $57 every month for 360 months, and it'll come out to be a better deal than this. But most people choose somewhere here in the middle, and it's basically up to you to decide where you want to be with that. Okay, we usually try to find different options so that you can be comfortable with your payment depending on your goals. Okay, if your goal is to cash out, you may not want to. Your cash out may actually include the credit. So if you're cashing out $100,000, this $10,000 can be lumped into your cash out amount and then give you a nice low interest rate. So there's no such thing as a free loan, but you can receive a credit that correlates to a free loan, as you can see here. So the numbers on your spreadsheet in parentheses represents what would be a credit, and that's how you read it. Now, the thing about this is pricing does change every day. So you have to make a decision usually before 4 o'clock, because after 4 o'clock, the lender will close and the lock desk will close. So we try to send this to you as soon as we can, but sometimes you have to do this the next day and so forth. Again, for a refinance, the base amount of the cost is about $2,800. So on a refinance, it's a little bit less expensive and you can receive more credit. Now this particular scenario is just an example. Of course, rates are going to vary depending on where we are and in the market. But I just wanted to show you a little bit about how we operate and what you can do with the spreadsheet so it's clear. All right, thank you very much.